When things go a little wacky, then you can see what's called an inverted yield curve. The relationship inverses there, and you have the short-term rate higher than the long-term rate.
You've heard it here on this podcast before. It's not about timing the market, guys. It's about time in the market.
You're never going to know, again, with the timing, just because things look expensive right now. You never know the timing. They could continue to run up. You could have a correction that starts next week.
So much of the focus right now is on AI. The excitement is around AI. So what do you see there? What do you see as maybe some of the key differences between what we saw back in 2000 versus what we're seeing now in 2025? Hello. Welcome back to Living Richly with Curo. This is episode 77. My name is Ann McCabe. I am the CEO and a partner here at Curo Private Wealth. And I'm joined, as always, by my lovely partner, Atricia.
Hello, I am Atricia Roberts, COO and partner here at Curo. Thanks for coming back if you've been with us before, and thanks for checking us out if you're new to the Living Richly podcast.
Yes, we love all of you. We appreciate all of you. And if you are new to the podcast, our goal here is to educate, inspire, and empower you on your financial journeys. And today, as you can see, we have a very special guest, a member of our Curo team, Zander Cochran. Welcome, Zander.
Thank you. Thank you for having me.
Welcome. Oh, love having you here.
Yeah, we're really excited to have you. And the reason, y'all, that we have Zander on the podcast today is because we got an awesome question from one of our listeners and viewers where basically he said, which are the most important economic indicators that we need to be watching to understand where we are in the economy, how things are going? And so Atricia and I thought, you know what, Zander, who is our planning and investment associate, he runs our investment committee on the Curo team, would be the perfect person to come on and answer this question.
Yeah, very excited to hear your insight today, Zander.
Thanks.
Yeah, we wanted to make it a little bit more challenging for Zander because we know he can handle it. So instead of letting him name 25 different economic indicators, because that would be way too easy, we said, all right, you're on a desert island and you only get to pick 3. So 3 economic indicators, which is a very hard thing to do. So we realized, Zander, this is a challenging question, but we want you to pick 3 and we want you to explain why these are the 3 that you're picking, what they mean, and what they're saying about the current state of the economy. And before we go further, I just want to give a shout out to Marvin. This question came from Marvin. He's going to be getting an Amazon gift card for the awesome question that he sent in. So shout out to Marvin, and apologies, Zander, that we made the question a little bit more, challenging than Marvin originally designed it, but we know you can handle it. And listen, if you have to sprinkle in an extra 1 or 2, totally fine. So before we get into the economic indicators, Zander, you have a really cool story about how you became interested in investing and why you decided to get into this industry. So share with our listeners and viewers a little bit about your background and your story.
Yeah, sure. So I first got exposed to the industry originally through my grandfather. He was a stockbroker back in the day for his career. Later was managing practices as well, just like you all. And of course, the industry looked a lot different 30 plus years ago than it does now. But that was kind of where I first got introduced to it through my grandfather. And so I had some conversations when I was pretty young with him, and actually got into investing myself when I was a freshman in high school. So I had saved up some money that I did from mowing lawns that summer. And so I figured I wanted to invest in the stock market. I didn't have really any idea what I was doing, except that I liked the idea of being able to grow my wealth for the long term and having that ability to kind of sit on it and grow over time. So I got pretty lucky in my first choices. I ended up buying some shares of Starbucks and Apple as my first stocks.
Nice.
Which seems like it's great, right?
Especially right out of the gate.
Back.
Yeah.
That was actually 20 years ago, October of 2005, which now we're in 25. So what happened was I have not held on Apple or Starbucks that entire time. Wish I had at this point. But I invested it. After 3 months, I was realizing that the stocks were doing pretty good. I think Starbucks was up like 10% at the time. Apple was up like 30% in just a course of 3 months. So I figured, oh, that's probably a pretty good return, averaging about 20% in just 3 months. So I did what I shouldn't have done, but I sold. And I took my profit there, which with a little bit of lawn money over the summer, it's a nice little profit when you're 14 at the time. But of course, I wish I held those shares for a couple decades and would be doing much better with that. But that's kind of my first introduction into the investing world. From there, read a bunch of books, got interested in investing, went to school for college, and the rest is history.
Yeah. And we're so grateful that you found Curo.
Yeah. You've been such an
Me too.
asset to our team. But I also want to add this caveat. Remember, and you've heard it here on this podcast before, it's not about timing the market, guys. It's about time in the market.
Yes, I learned that the hard way. But better to
Yes.
learn early.
Yes, for sure.
Yeah, with less money. Exactly.
All right, Zander. Well, now the people are waiting. We're here with bated breath. Let us know, what would you say is your first of 3 indicators for the economy?
Yeah, so I would say the first one, and this is something that we actually have been looking at for investment committee for quite some time now, every month. And that would be looking at the difference between the 10-year US Treasury and the 3-month Treasury. The difference of the two is called the spread. Basically, what you're looking at is kind of envelops the yield curve. So when you're looking at bonds, and particularly for US government bonds, typically on a normalized yield curve, you see shorter term treasuries lower and longer term treasuries like 10-year, 30-year at a higher interest rate. When things go a little wacky, then you can see what's called an inverted yield curve. The relationship inverses there, and you have the short-term rate higher than the long-term rate. So looking at that spread there is something that I'd probably look at. Historically, it had been a pretty good indicator when that goes negative and then reverses and it goes positive again, as a pretty good indicator for impending recession. This time around, it has not worked out that way, but I think it's still a good kind of sniff test. The bond market's basically saying something's funky going on in the economy right now. And so currently we're standing at 0.02 for the spread. So it's very flat right now, at least for the 3-month versus the 10-year on the curve. And it has been for a while, but kind of interested to see, watching where that breaks. Probably will move higher as the Fed is looking to continue to cut interest rates. But I think that's kind of a telling sign that something's going on and that you should take a closer look when that's looking inverted, as it has been.
Yeah, because it doesn't make sense logically, right? Like logically, let's say you were going to buy a CD, you would expect that if you tied your money up for a longer term, let's say for 5 years, that you would get a higher rate than if you buy like a 6-month CD. But the inverse is happening, where you're actually getting higher interest rates on, a 6-month CD than you would on a 5-year, which is just backwards, right? So to your point, that means there's something strange going on.
Yep.
All right. So y'all heard it here. Yield curve. This is one of those things you can sound really smart at a cocktail. At your next cocktail party, you can talk about the yield curve and the yield curve inversion and what it means.
And the spread.
And the spread. You're welcome. All right. Indicator number 2. What do we got?
So for indicator number 2, I would probably want to look at the labor market. And specifically, there's lots of different indicators. Probably most widely looked at would be the unemployment rate. So for the second one, I would actually want to look at the unemployment weekly claims. So seasonally adjusted, looking at initial unemployment claims. So essentially, someone loses a job, they're filing for unemployment benefits. And it's kind of showing a level where if there's more people that are looking for jobs, essentially, or needing to get money through unemployment insurance because they don't have an income, That's another sign that's kind of showing the health of the overall economy and kind of at a pretty snapshot moment as well, because it's looking at weekly data. So I don't remember which economist I heard this from, but basically if that weekly level is at 250,000 or above for at least a month, maybe it was a few months, that's kind of a warning sign of that's the level you want to keep watch. If it's been consistent for a while at a higher level, that probably means that companies are laying people off. So the companies their revenue's not doing as good. It's probably a downturn. They're looking to raise margins. The only way, or one of the ways that they can do that is by laying people off. So that's probably the second one that I would look at. So I can't remember where I heard it from. It may have been Dr. David Kelly from JP Morgan. It may have been Jeffrey Gunlock from Double Line Capital. It may have been someone else, but some smart guy said it. So
I don't know. I say at this point, you just own it. You just take credit for.
If you don't know who to cite, then just cite yourself.
Yeah, right. You cite the original person like the first 2 or 3 times, and then it just is like a thing that it's in your repertoire.
Yeah.
But Zander, can you talk a little bit about what that's looking like right now in the labor market?
Yeah. So right now, the initial claims number was at 218,000 for the most recent data, which we haven't got the most recent data really because of the current government shutdown. But at least from September 25th. So if that had moved higher, the 250,000 was the level that I said. And if it stays at that level for some time, we have seen throughout the year it pop up briefly for a week and then come back down. So that's kind of you want to watch and see what happens. But we have not been at that point over the course of this year, despite the slowing labor market overall that we've definitely seen this year.
How is the immigration situation affecting the labor market? Because presumably with a lot of people leaving the country, we have less in the labor force. Is that correct?
Right. So I wouldn't say it's as much of people leaving the country. It's more of less people coming into the country. So because it's tighter borders, there's less people coming in. So maybe in some strange way, that's actually kind of helping the labor market a little bit, because if there's not enough jobs, but there's also less population growth, particularly from immigration, then that kind of both sides of the equation even out a little bit. There's kind of the opposite side, what happened in, 2022, 2023, when the population was growing faster because more open border policy. But then back then, there was also a lot of need for laborers as well. A lot of companies were having a hard time finding people, and wages were going up because of that, because there was kind of not enough supply for the demand that was in the labor market at the time, kind of off the back of all the supply chain stuff that had gone on post-pandemic. So it's kind of the opposite of that now, I would say. So again, because both sides of the equation are kind of moving, I think that's part of the reason why we haven't seen the unemployment rate move up too much and why it's stayed pretty range-bound.
Yeah, because you've got the numerator and the denominator. So if there's movements on both of those, they can cancel each other out.
Right. So you mentioned unemployment claims. You mentioned unemployment rate. Are there any other labor market reports, things that you pay attention to or that our listeners or viewers should maybe pay attention to?
Yeah, so another one would be JOLTS, which is job openings numbers. You can kind of see that shows on the side for the employers what positions they're looking to fill. And then you can kind of look at that as a ratio compared to the number of unemployed people. And so I forget exactly what that ratio is called, but essentially it's the number of job openings versus the number of people who are looking for a job. That had fallen slightly below 1. Basically, it means that there's more unemployed people than job openings available at the time. That had been higher more recently and then moved kind of into equilibrium at this point. So that's probably another labor market one that I would look at.
Very helpful. Thank you. Alrighty. So we're going to drum roll for our
Did we leave
third.
the best for last, or is this the worst for last? I don't know how you ordered them, but
Yeah. All right. So for number 3, I'm going to switch over to the equity side of things a little bit. So particularly on valuations, and it's another chart that we like to look at for the investment committee, is looking particularly at the forward PE ratio of the S&P 500. So I think that kind of gives a couple bits of information that's helpful. So the first one is the forward PE ratio is how much essentially investors are willing to pay for the expected next 12 months of earnings for the companies within the S&P 500, and it's a multiple of that. And so that the higher the multiple essentially means the more excited investors are, they're willing to pay more for the income dollar that they're receiving in return, or they should be over the next 12 months. So it's kind of a bit of investor confidence, a little bit. How confident are investors in the future? Part of that is growth expectations. If you have a higher multiple, you probably expect higher growth expectations as well, which we do see right now. But I think also more importantly, it shows on the valuation side of things how expensive, how frothy are stocks overall right now. And so that's kind of could be another warning sign. It's not a short-term indicator whatsoever. Just because stocks are expensive right now doesn't mean that they can't get more expensive. But it is at least kind of a warning sign and saying, hey, things are a little expensive right now. If you're buying in now with new money as an investor, you should probably expect below average returns moving forward because you're paying up front. So that's probably the last one that I would say is just looking at that from a kind of big picture of how the market looks, but then also an evaluation perspective and kind of see, how much are you willing to pay for earnings? And if you're paying too much for earnings or other investors are willing to pay too much for earnings, then maybe you should kind of look at yourself and your own portfolio and see, hey, if things are too expensive, can I maybe reallocate some of this money to other opportunities that are a little bit better valued right now?
So on that note, Zander, there has been a lot of comparison between 2025 and where we're seeing S&P 500 valuations and the tech bubble that proceeded to burst, especially because so much of the focus right now is on AI. The excitement is around AI. So what do you see there? What do you see as maybe some of the key differences between what we saw back in 2000 versus what we're seeing now in 2025?
Yeah. So I'll start with a key similarity, and that's there definitely is, and it's actually more so, a lot of market concentration in the largest names within the S&P 500 index. Actually, in 2000, kind of at the peak of the dot-com bubble, it was over 20% concentration. I think it might have hit over 25% for the top 10 names within the index. So essentially, top 10 names out of 500 counted for over 25%. Currently, in today's environment, it's actually higher at around 40%. So just the top 10 names, which is essentially the Magnificent Seven stocks, so a lot of tech-related names, plus a couple others thrown in there like JP Morgan Chase and Berkshire Hathaway, that kind of encompass those 10 names currently. So right now, the market's definitely more concentrated at 40% for just those 10 largest names. Now, one key difference, though, I would say, is the earnings power of those companies. So if you look at the earnings today of those 10 companies, they make up 32.5% of the S&P 500's total earnings. So it's not 40% where they are. So they're a little higher valuation compared to the rest of the names in there, but they're not kind of way off the charts. Versus you go back in 2000 for the dot-com bubble, the earning power of those names was much less. And so basically the valuation for some of those names, think like Cisco, was much higher compared to companies today like NVIDIA, which despite their phenomenal stock growth, they've also had phenomenal earnings growth, kind of keeping up with that over time as well. Just kind of with that, the cash flow that these companies are able to generate puts them at a much more healthy and sustainable level compared to what we saw during the dot-com bubble around 2000. So I'd say that's probably the key difference right now. Doesn't mean that things can't get more expensive, and we do kind of the infrastructure build out that we're seeing for AI kind of gets overbuilt out to the point where those companies aren't getting good returns on their investment. That's definitely a possibility, but I don't think we're quite to that degree yet. The other thing I'll mention, and it's not necessarily a one for one, but going back in 2000, we saw in 1995, 96, 97, 98, and 99, all 5 of those years were years where the S&P 500 returned 20% or more. So it's a 5-year period. So it's a very long buildup over time versus currently we saw in 23 and then 24, 2 years of back-to-back 20% plus returns for the S&P 500. Currently, in 2025, we're in double-digit territory, not yet 20%. It's possible we could get there. I don't know. So essentially, we don't have quite the amount of time that we saw for the buildup for the dot-com bubble. Don't want to make exact comparisons and say, oh, we got a couple more years before things get too bad. You're never going to know, again, with the timing, just because things look expensive right now. You never know the timing. They could continue to run up. You could have a correction that starts next week.
Right.
Mm-hmm.
So you never really know.
Yeah. And what is that forward PE ratio of the S&P now? I mean, you may not know the exact number as of yesterday, but what does that number look like compared to maybe where we were dot-com bubble, or even what we are average over the long term?
Yep. So that level as of September 30th was 22.8 times. The peak in 2000 or 99 leading up to that hit just over 24 times. So we're getting pretty close there. It's probably another 5%. If earnings stayed flat and the S&P 500 moved up another 5-6%, that's probably when we kind of hit on par with those dot-com levels for forward earnings. So the nice thing is right now expectations are earnings are going to continue to grow. So if the S&P 500 moves up another 5% over the next couple of quarters, we're probably going to see earnings move up as well. So that's kind of going to slow the pace a little bit of the forward P moving higher if that did happen. But that's kind of a comparison. And then the 30-year average is at 17 times. So that kind of shows you right now at 22 times versus 17 times. That's a pretty big difference in terms of how much investors are willing to spend right now for those future earnings.
Yeah, everybody's so excited. It's the market that kind of takes a quick licking and just keeps on ticking, running up to all new highs every other week, it seems.
Yeah, doesn't seem like really anything is stopping it right now, but that could turn on a dime.
Yeah, anything could make that go the other direction.
Yeah, exactly. All right, awesome. Great job, Zander. We knew you could do it. There you have it. There are so many more economic indicators, obviously, but those are the 3 that are, if you had to pick 3, those are the 3 possibly most important ones. So awesome job. All right, it's time for our closing thought of the day. So let's start with you, Zander, since you're our special guest today. What do you have as a closing thought?
Well, I guess I'll keep it with the market talk because that's what we were on. So we've been kind of discussing in our own investment committee of where we are from kind of outlook going forward. There's definitely some various degrees of where we think we are in terms of being a little bit more on the bullish side, a little bit more on the bearish side. And so I would say overall, just in terms of as a committee, we've been talking about being cautiously optimistic about the economy and the market overall. I know Atricia is definitely not so much on the optimistic side at this point.
But on the cautious.
Yeah, just the cautious.
Just the cautious part right now. That could change.
Yeah. So I just want to say, like, despite everything that's going on, there's still no way of knowing which way things could turn. So I think it's just important to remember that because the outcomes are pretty varied in terms of one path going forward is kind of growth heavy. Let's say everything works out on the artificial intelligence side of things in terms of productivity and earnings. You can see one path there. And then you can see another path, which I think is a little bit more clouded. There could be some event that happens kind of out of the blue, some kind of black swan event that really makes the current picture of how investors see things all of a sudden look and like that's, the rose colored glasses have to come off because of some bad news that impacts the market. And we don't know necessarily what that was. Looking back in April, that looked like it was tariffs. But I think that the impact of tariffs has been less of an immediate shock to the economy, although it was an immediate shock to the market. And it's another good thing to remember that the market is not the economy overall. So they can definitely vary on those paths going forward. But just kind of overall, we don't know exactly what's going to happen. So the best case scenario for that is be prepared for both paths going forward, whether it's the growth path going forward and that kind of continuing and probably valuations get even richer from where they are, or something comes out of left field, whatever it is on the negative side, and we see a correction. It could just be because valuations are too high and something happens. But you want to be prepared for both and have that built in to portfolios. And that's really how we're positioned now for client portfolios.
Yes.
Yeah.
All right. Awesome.
All right. And I know you're excited about your thoughts, so I'm going to let you
I
go
was gonna say you, but okay, we'll give you let you off the hook real quick.
Thank you.
All right. So my closing thought today is actually for all those parents out there and for potentially future parents or, any people who have kids in their life. So we will frequently hear, and I've said it myself, I want to give my kids a better life than I had, right? I want to give my kids, I don't ever say I want to give my kids everything because I definitely don't want to give my kids everything. But I came across a quote that really struck me. And it said, giving your kids everything you didn't have might cost them what you did have, like work ethic, drive, and determination. And that really hit home for me because I think so many of us who had to work really hard to get where we are, like I worked full time during college and went to college, took, 18 hours of credits and worked. And it was really hard at the time, but it absolutely was, made me who I am today. And I learned a lot from that. And so I think just as parents balancing, yes, wanting to give our kids great experiences and a great life and, make sure they've got food on their plates and shelter and all those important things. But at a certain point too, we need to make sure that we're giving our kids the gift of hard work and adversity so that they can learn to be as strong as we have had to become.
That's a great point. I think we've had a conversation on the pod before about how we grew up as latchkey kids, like very, very independent.
Yes.
And sort of the new generation of, preteens and teens are very dependent on, parents. And so I think sometimes there's an overcorrection from generation to generation. You want to do it so different than the way someone did it for you that sometimes we maybe rob, young kids of some opportunity to get some grit.
For sure.
Because if you've never had to come home and make your own, ramen noodles or whatever you ate after school and fend for yourself till your parents got there, then how are you supposed to make it out here in the world?
Yeah, exactly. Precisely.
Thanks. All right. Well, I always am struggling for a closing thought, but the thing that comes to mind today is something that we've been working on internally as leaders, and that's developing ourselves as leaders and focusing some internal training on being better leaders. So I always think about the good leaders I've had in the past, the bad leaders I've had. We often ask that question when we interview new team members. Tell us about your best boss and your least favorite boss. I think of it as leading with charisma. Do you want to be a charismatic leader or do you want to be a tyrannical leader, right? Do you want to lead because people are afraid of you, right? People follow and listen because they're afraid. So I think Anne and I are both in agreement that we want to be charismatic leaders and we want to grow a team that is excited to work with and for us because they believe in the vision of what we're doing moving forward. So I hope that's what Zander feels when he works with us every day, that we're not tyrants. But just the thought about developing that leadership set and determining how you want to lead and how you want to show up for your team. So that's what comes to mind today in my closing thought.
Love that. See, you always pull out great ones.
It's always at the very last moment. So,
but that's like, it's spontaneous, but it's like whatever is coming your way, which is great. Yeah. Whatever you're thinking about in the present moment. All right, y'all. Well, that wraps us for another episode. Zander, thank you so much. You were awesome. Not surprising. Thank you for joining us. We loved having you on the podcast, and know that our listeners and viewers will get so much good information. They're going to sound so much smarter at those cocktail parties than they would have prior because of you. So thank you for that. Thanks again, Marvin, for the question.
Okay.
And we will see you back here next week for another episode. Until then,
live richly.
Thanks again for tuning in. If you enjoyed today's episode, please be sure to subscribe and share it with someone who might benefit from it. Friendly reminder that this is for informational purposes only. For additional information, please visit us at www.curoprivatewealth.com. Until next time, live richly.